All right, so live again on the channel. I'm gonna be also streaming on my TikTok as well, so gonna be posting the link to that at the end of this live stream. So I'm finally getting in some requests. Um, some of the questions I can see that many of you are still stuck in retail level trading. So while I'm gonna be answering your questions, I'm also gonna try my very best to enlighten and also steer you guys towards algorithm style trading because the moment I see certain questions being asked, it dawned on me. This person, this young trader is still thinking like a retail trader and it's gonna put them in a lot of trouble. So this discussion is centered around entry models. Now, getting straight to the point, there are two entry time frames that I wholeheartedly recommend. The M1 and the M5, but I stick with the M1. M5 is also good and M15 can also work, but I stick with the M1. Now, the entry model ties into the whole algorithm. You can essentially trade this entry model on any asset, but I often recommend you stick to an asset that you have been around for quite some time, you're comfortable with, you're not following a fellow trader because they trade this asset. You're just on this asset because you like how it moves. For those who have been following my channel, you can see that I've stick to just the assets that I know, gold, GJ, recently added Dow Jones and Nasdaq, but I stick to assets that I've been studying, watch how they move, historically have a liking for it, and so on. So the first thing you have to understand when you're looking for an entry, and I'm going to repeat this again, is that money should not be the first thing that comes to your mind. The money is the final stage of all of this, and at the same time, um, most of the trading techniques that you employ for entries, you're not gonna make the money long term. Eventually, you're gonna get stopped out. It's only gonna open you up to a small window of profitability, and then once you do eventually get stopped out because you read the market with retail knowledge, then you're gonna find yourself in a tough spot. I need to seriously get my desktop back up and running. I need a dual screen for um this laptop. Yeah, I want to be able to interact. So I'm gonna set that up later on. So okay, let's get into this right about now. So as you can currently see, I'm on the Nasdaq. Now we're at 25,928. If I'm gonna be looking at an entry for this asset, I have to first know where the current market players are, and I have to navigate the chart by properly labeling and getting a forecast because while I'm looking to enter, the market is currently in play. The market is live and open. That simply means that there are traders that are intending for the price to go in a direction that the market maker is going to stop on. When I say traders, I mean retail traders. Whereas the smart money traders are going to be looking for the price to head into a direction that clearly after the stop hunt has been completed, it's going to be a profitable move for them. If you guys get what I'm saying. So what time frame can you start on? You can start on any time frame that makes you feel comfortable in terms of your analysis. I start on the daily and work my way down, but sometimes I don't even need the daily. I can start simply on the 4 hour. But for this lesson, I'm going to start on the daily candle. So let me big up the screen just a bit and express what's been happening. So this is current Wednesday, this is Tuesday, obviously this is Monday, right? So we already have established what we call a low, high for the week and so on. Now, if I were to draw it over here, naturally, I'm gonna have to adjust it on the smaller time frame. So let's go on the 1 hour chart, right? The reason why I'm going on the 1 hour chart is because it's going to make mapping out all of this a little bit quicker for me and a lot easier because all I have to do is find the start of the week, the very first trading day, and essentially on my way. So let's find Monday. Let's find Monday quickly. And upon finding Monday, I can then quickly navigate out and find the high that the market price set. I'm just doing the labeling. I'm gonna jump in right after into the overall entry, and that's where the discussion is gonna take up the bulk of this video, this stream. So right here says Wednesday. So obviously Tuesday has made the low of the week so far, as we saw earlier on the daily chart, and Wednesday is currently in motion, currently in play. Already we have gotten a ton load of information already, right? The market price started off bearish, made a low that has been respected, and Wednesday opened higher than the low that was made on Tuesday. Right, so this is the current low of the market price for this week. Now, here comes the entry aspect of this now. Most people probably looking at this and saying, Darren, you only draw two lines and so on. Well, look at this. I've already gotten my answer, and I've already gotten a forecasted preview of what to expect for the following days. Let me explain step by step now. I'm going to go on the 15-minute chart now, then work my way down to the entry time frame. Right? As you can see, the market price gave us the low of Wednesday so far, because the day hasn't come to an end. And the asset price went up, pulled back, break of structure. All right, one, and then right here, so two, current structural zone. All right. Now, in the long-term grand scheme of things, what is the market price trying to do or trying to tell us? The market price is telling us that it is currently running to go for the traders who entered on Monday and also those who entered on Tuesday because they are, in profit. Well, actually the Monday traders, because if you take a quick look where Tuesday started, you would quickly realize that majority of the persons who are entered on the market price on Tuesday, they have been taken out of the market, right? All of this is Tuesday. Cool. Tuesday was a contracted day. Now, given that we have run the stops of those who sold on Tuesday, it stands to reason that the market price is heading for those who are currently in profit on Monday. So I already now have a forecast of where the market price is heading. I see where price broke out and gave an impulsive move, and I see where market price has the current high. Simple stuff. Now here's the heart of the discussion. Where are the stop losses? Should I enter now? And will the market price continue to push higher? And furthermore, what type of risk management should I employ given that I've already missed and what is the crucial entry? There are two crucial entries that would have been highly advantageous for me. Entry number one would be obviously catching a pullback that was established from early Tuesday. But most persons would have been stopped out, especially if they move their stop loss to break even too quickly. And then obviously they would have had some doubts upon seeing this, depending on what level of trading they are at. But right here so would have been ideal, but sadly many persons didn't catch it. The reason right here so would be an ideal entry area. Oops, no press text. Yeah. The reason right here so would be an ideal entry area is the fact that many persons upon buying here, their stop loss would be at this low. So current Tuesday buyers, they are still in profit and they're going to be deep in profit should market price break higher. Those who entered on Wednesday, let's put B for buy, their stop losses are here. Now, when it comes on to marking out a impending move for a confirmation, don't rely on trend lines in terms of drawing sideways trend lines and trend channels. That's not going to help you. The Forex market most of the time is a linear market with strong impulsive breaks and then they go back into a linear contraction because that's where it sets up the liquidity traps and also that's where the capital is injected. Case in point right here. So this was an entrapment zone for many traders who sadly bought here and their stop losses were down here. So the market maker ran their stops, right? But right here, so we saw upon price going into this sell-off. For those who would have bought here, their stops didn't get run. They are currently in profit. But those who bought at the top of this impulsive move, their stops get run. Same thing is being applied right here, so. All right, the following. So at each interval of an impulsive move, we wait to see, and this is not pattern trading, by the way, this is stop loss analysis, right? We wait to see if the impulse that is currently taking place, now this is a sell-off move, retracement. We're waiting to see, for example, if the market maker is going to be pleased to run the stops of those who bought here. And your stop loss would be either here or a tad bit closer, right here, meaning that their stop losses would be above the initial structural or the first wave. Follow me? So first wave buyers are here, and they're still in profit if they didn't move their stop loss to break even. And second wave buyers, which are the justification, are here. So the market is currently retracing. I cannot under any circumstance look to say I'm going to jump in at the bottom of this candlestick. That is not a proper entry model. The impulsive move has started, M5 chart. Yep, going right down to the smaller time frame. The impulsive move has started and it's by far a brilliant sell. Right? Decent look sell off. Anybody who caught this scalp, good for you. So structure wise, I have my floor, I have my peak roof, and the market maker is now in for some stop losses. Now, how this ties into entry model trading? Well, first and foremost, I understand that market price has to break past my crown. In order, and this would be the biggest confirmation, should price stay above this crown, this would be the biggest confirmation that price is going to continue. So where in fact should I take my entry? There are two entries that are available to me right about now. One ties into the equilibrium of this impulsive move, and the next one ties into whether the stop losses of those who entered on this justification era is ran. And I'm gonna back out the brush right about now to elaborate on this. So quickly, let's say right here says EQ, the equilibrium era. If the equilibrium era is maintained, mean that the market maker only wipes out 50% of the traders who bought and caught this impulsive move, and then he stays, let's say, above this equilibrium area, and then I see this current retracement is being swallowed up by bull candles, then upon the correction, if it stays above the equilibrium, I can take a buy entry. And then I would place my stop loss below this line. Okay? Provided I see that setup. On the flip side now, which would give me a far better advantageous move, the market maker, get this out of the way, breaks below equilibrium, pierces the previous structural high, PSH, pierces above, pierces below previous structural high, meaning it breaks it, then I watching to see if the market maker is going to be targeting the stop losses here of the justification bias. So he runs, targets their stops, takes them out. Now, if he takes them out and then re-enters, I'm not gonna enter on the first wave. I'm gonna wait to see if he justifiably pulls back the market price down, and he can do it choppy sideways anyway. But the key thing I'm looking for is price to respect this level. Once I see price respect this level and then starts to climb back again, I am taking my entry on that move on the next impulse I see forming. You're gonna get this razor sharp accurate on the smaller time frames like M5, M1. All right. If I see that, all I'm waiting to see is a breakback of all the previous zones, and it's not gonna come in a one nice, beautiful. Nah, don't look for that. Sometimes it's gonna come stringy, choppy, all type of things, as long as it's taking out those key levels. Once it has done the liquidity run, once it has wiped out the liquidity of those traders, should it play out to that effect? We are looking for the correction. Just to show you guys, it can even come stringy like this. As long as I see my market price making a break, I'm all for it. Once it is not making those breaks, then any move that I have, Especially if I see that I locked in on some decent profits, I'm gonna exit. That's the truth of the matter. So right about now, top to bottom, let me, because I know for some of you younger traders, you might be confused. Some of just use the Fibonacci quick to show you, right? So price has pierced below equilibrium at this present moment. Cool. If it continues to form candlesticks and break below it, I am looking at these stops to be targeted, as I mentioned earlier. If that doesn't happen and price then re-breaks above equilibrium, stays above it, and is pleased to say, all right, structural wise, I am climbing back up, I can take my entry off of one of those retracements on the way back up. So here or even here. Cool? Because I'm then looking for a break of structure. That's what I'm looking for. If I don't see that, I'm not taking it. And that lies in the discipline of trading Forex, the algorithm style. It's all quite simple. M1 chart, for those who want to see the moves in Forex laid bare in front of us. It's all about liquidity price hunt and what market maker looks for in terms of overall price grabs. I understand that moves like these, once price reach a peak, market maker usually takes out 50% of the move. That's just written in stone for me at that present moment. If I miss the move, there's nothing I can do. But what I can do is wait for the next move to take place. Now, before the next move takes place, which in this case would be a continuation of the buy, which would confirm my bias, I have to see what is he going to do to the current players in the market first. Once I see if it, okay, for example, let's say he doesn't take out the stop loss of the buyers here. That is one of the biggest confirmations, Sammy, because then more buyers will be entering on the move and I'm on my way. Because they who miss this first leg, upon seeing this price pullback, this is literally telling them, okay, here's your opportunity for jump in. And now even more buyers are going to jump in. And then the momentum will in fact give me that break of structure that I'm looking for. Because why? It couldn't break past his crown. So he pulled back. So this is a discount. So upon seeing that he doesn't run the stops of those from earlier, from the justification, I'm on my way. The same essence, or should I say, the same analysis can be applied even if it was a sell move. That's the simplicity of all of this. You guys following so far? All right. Now, in the essence of time and knowledge, so we're still on entry models discussion. Now, this is going to reinforce everything I said earlier, just now, but with the pre-labels in already. Now, we should know that eventually our next buy-off is going to come, but I'll get to that in the latter part. This is what happens to a trend move, and this is a confirmation for future entry models for you to reinforce when a trend is going to continue. This right here so is Friday, right? The Friday seller stop losses are here. Right here so is Monday. The Monday sellers, their stop losses are, here. Cool? Right here so this is Tuesday. The stop losses of those in Tuesday are here, and so on. Cool? Notice I have buying right here so. This is a forecasted level, or should I say box that I drew. Should the market price on Wednesday would have undoubtedly come and taken out that level, because buying would be the one, or should I say the move, that would be targeting the stop losses of those from Friday, Monday, and so on. Now, the intraday traders who held their trade over from Friday, they are still deep in profit and getting deeper in profit. But what am I trying to really reinforce in this discussion right about now? People, take a look at this. This is what we call price entrapment, fake outs, and just about, heartache so many traders. I think I'm gonna go on the M5 for this. So Yeah, because I want to do this step by step by step. The more of you can see it this way, the better it can be for everybody, right? Cool. Now, this is Wednesday. This is the first 5-minute candlestick for Wednesday, given the current time frame that we're on. All right. Perfect. Perfect. Look what the market price did in the closing part of Tuesday. This is Tuesday's daily low. Stringy price action movement. We understand that. But that was a low that was what? That was a low that was respected. And because it was respected, eventually we saw buyers entered at these intervals. 1, 2, 3 buyers entered at these intervals. So there's a ton load of stop losses in these areas, right? Cool. The price kept on going and price went above a equilibrium area. Now this equilibrium line, this red line is drawn from the range that was set from the previous week. Cool. I'll go back on the smaller, a higher time frame quickly to show you. But what I want you guys to take a look at is this. First, the price pullback. So those who sell into this area, the market maker went and took out their stop losses, right? Gave us a peak high. Now, this is good news for you if the market price had stayed above equilibrium. Upon seeing the bear candle start to come through and re-pierce back equilibrium, this is the halfway range of the previous week. Any single trader that still kept on holding on to a buy, you are not a trader that is ready. Or should I say, you're not ready for Forex. And I'm just going to be as blunt as possible. Because clearly you're not navigating out the chart properly. This is a decent impulsive buy move. Upon market price coming crashing back down, you should have quickly realized that not only the buyers here on Wednesday, but those who entered, the intraday traders who entered from from Tuesday, cool? Their stops, which are in this vicinity, the market maker is coming for them strongly. Now, I know many persons would pray, stubborn at this point and don't want to, let go. Look what happened. Price then came and price pierced below the daily low on Tuesday. Now, if low breaks and fails to break above this area, more selling is expected. I drew this yesterday, right? Before Wednesday even came on the scene, I had this forecasted out. Now, to add, salt to injury, look at the move that the price did. This is where I'm going to really get into this right about now. So I might have to just pull this. I may just get this out of the way temporarily. I want you guys to look at this. I know many of you say patterns, these are higher lows. I'm not looking at this in the essence of higher lows or so on. I'm looking at this in terms of, I thought I muted that chat, in terms of stop losses, right? First leg, most people missed it, right? And then price came, stopped the first wave of buyers, stopped the second leg of buyers. But we saw market price doing something that would have confirmed that an impulsive buy move is coming. Let me show you. Buyers, stop loss. This is how I want to start look. Now I'm just gonna draw one little box right so I'm lazy. Alright. More buyers. Buyers. Cool. But if they had placed their stop loss right here, are good. The smart money ones, the retail ones, obviously, who caught it at the top, their stops got ran. But then price broke above and we saw all of the deviation areas. This is where you can look to the left now. So all of the sellers from over here, sellers, 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 they are currently being wiped out by these, advancing bulls, if I can use that term. Cool? Now, price came, equilibrium, pullback, touch the area. Now, this brings me back to entry models. and why navigating your chart with proper labeling is crucial. You see, this would just stand out in front of me if price stay above equilibrium. You cannot just draw a bunch of lines on a chart and you don't properly label your chart. You're like a captain on a ship without a proper manifest. You don't know what angle to turn, what degree, what weather to avoid, what areas, rocks, geographically on the seabed. So you need to avoid this area. You're just putting yourself in a lot of trouble, right? If price stay above equilibrium, you see, this is a strong impulsive move, pullback. Now, let me tell you why this area would trip up a lot of traders. A lot of traders would read this wrong. But some smart money traders would actually catch on and realize what's happening. And I pray that this video is, really shared. People, look at this. Strong pullback, right? Then respected floor. So peak, just use a trend line here. So peak, floor. Sellers sold into this, right? Cool. Their stop loss are in this vicinity. But most smart money sellers, their stop loss would be a little bit higher. But some of them did get tagged out if their stop loss were too close. Price then came, took out those at break even. Price came and pierce, not break. There's a difference between break and pierce. A true price break is when there's a continuation of candles that stay above a respected price zone area. A pierce is when it fails to do that. It's the exact opposite. So this is a price. So you cannot buy here. That would not be a true setup. You should have seen the price come above this area. And if it is pleased to retest this line and stay above it and then start to climb, then you could take a buy on one of the pullbacks. But other than that, no, that doesn't qualify as an entry. This doesn't qualify as an entry. Furthermore, there was a rejection here, and now price is going back to the same area. So I know many of you read this and say, well, it gave us a discount. That means it nah. This is where I made a lot of mistake. You did not get any confirmation for the entry for a buy. Not because you see one, two, three big, beautiful green candles, bull candles form and set the price here. That doesn't mean that the market price was going to say, all right, I'm going to, shoot. You didn't see it break and stay above the area. That was the criteria for the entry. And that didn't come true. And because you bought into this impulse, and the market maker know that you guys bought into this impulse, he's coming for you. Not in the way that you like. Because look what happened. Remember this little line that we draw up? I keep telling you, every single impulse has a era. A start, a equilibrium, and a finish. So we understand so all of these earlier sellers got wiped out. But now the sellers are coming back with a vengeance. Look at this now. Massive fall. You remember the stop losses that the buyers were on this leg? Well, goodbye. Goodbye. I saw this coming and I didn't even have to look at the DXY. Goodbye. And here we have it now. Now, which brings us to the wrapping up stage of this analysis right about now. Which brings me right back to the higher time frame, 1 hour. Perfect. So where are we right about now? Let's zoom in. So this is last week, Monday. The market price of this current week in November is currently resting on the weekly low and it is above the weekly low of last week, November, which is around November the 10th. This is an opportunity for many of you who essentially lost money to try to make some money on the recovery. And let me explain now. Back to the 15-minute chart now, in the interest of time. In the interest of time. Now we already understand that it's a strong impulsive move. Cool. Now what needs to happen is this. Upon market price respecting the structural low, because Thursday is coming up. So Thursday is the end of the cycle, right? Upon market price respecting the structural low, should we see market price then proceed to give us an impulsive move up. All right, 5 minutes. I have no choice. You have to see market price give us a first wave impulsive move up, followed by a pullback. This doesn't qualify. This is just a retracement and it immediately saw the stop get ran and so on. So that doesn't qualify. So we have to see a first wave up, price pullback, and it would be wonderful if the low, oh, wait a minute, it went below it. Okay, so this is the new low. So this is the current low. Yeah. And then on the justification, should it respect that low? We can take some buy because once you find the equilibrium area, you're on your way. If not, well, you already know the answer to that. If this doesn't hold, we're going south further. So I guess you can map out Thursday from early. Map out Thursday, mark the levels in which the market price comes to an end for this day. Mark them. Take a good note of the intraday traders who are entering in the closing part because more than likely they are gonna be stop hunted eventually. And then see if those levels are respected, then you can take an entry. All right. I'm gonna be possibly checking back on this, but the stream can be done over on my TikTok page. So as promised, I'm gonna leave the link to my TikTok page for you guys. So you can watch that live stream when it comes out. I'm gonna have to set up a live stream schedule so you guys can catch it. But this can be on YouTube, so can be played back. Alrighty then. So that's it for entry model discussion. If you guys enjoyed that, um, I really won't say there's a lot more to it because it's gonna really all boil back to discipline, patience, and understanding the algorithm of where the stop losses are, and you're gonna be on your way. So quickly, these guys are in profit. So if he's gonna be shooting it up, find the equilibrium part, right? So that's a little homework for you guys. Watch over my other videos. You'll see the hints that I dropped in those.